In this video, we'll explain how crypto taxes work in Ireland in 2026, which transactions may be taxable, how to calculate gains, when to pay capital gains tax, and how to prepare your crypto tax report. This video provides general educational information only. Crypto tax treatment depends on your individual circumstances, residence, activities, and transactions. Speak with a qualified Irish tax professional when necessary. We'll cover common taxable transactions, capital gains tax, crypto income, trading activity, filing and payment deadlines, record keeping, and how to prepare your report. The Irish tax year follows the calendar year. Your 2026 crypto tax calculations include relevant transactions from January 1st through December 31st, 2026. During 2026, self-assessment taxpayers generally file their 2025 Form 11 return by October 31st. The deadline is extended to November 18, 2026, when the relevant return and payment are completed through ROS. Ireland separates paying CGT from filing the final return. Tax on gains from January through November 2026 is generally due by December 15, 2026. Tax on December gains is due by January 31, 2027. Ireland does not have one special crypto tax. Existing tax rules are applied depending on the activity, taxpayer, and type of transaction. Most individual investors will generally deal with capital gains tax. However, organized and commercial crypto dealing may constitute a trade, with profits taxed under normal income tax rules. Calling a transaction a trade does not automatically mean you are carrying on a trade for tax purposes. Revenue considers the complete pattern and commercial nature of your activity. Capital gains tax may apply when you sell, exchange, spend, gift, transfer, or redeem a crypto asset. Cashing out to euros is not required. Selling Bitcoin or another crypto asset for euros is normally a disposal. You compare what you received with your acquisition cost and allowable transaction expenses. Exchanging one crypto asset for another can create a disposal. This also applies when one side of the transaction is a stablecoin. Using crypto to pay for goods or services can also be a disposal. You may need to calculate the difference between the crypto's euro value when spent and its original cost. Buying and holding crypto does not normally create a disposal by itself. However, you must keep the purchase details because they will be needed when you eventually dispose of the asset. Moving crypto between wallets that you own will generally not create a gain merely because the location changed, but both sides must be matched so the transfer is not incorrectly treated as a sale or unexplained withdrawal. The basic calculation starts with your disposal proceeds. From this, deduct the acquisition cost and eligible expenses connected with acquiring or disposing of the asset. Revenue recognizes that crypto prices can vary between exchanges. You should make a reasonable effort to use an appropriate euro valuation and keep evidence supporting the method used. The standard Irish capital gains tax rate is currently 33% for most gains. The tax applies to the taxable gain, not the entire amount received from the sale. Individuals generally receive an annual personal CGT exemption of €1,270. It applies across your total chargeable gains for the year, not separately to every crypto transaction. Unlike some other countries, Ireland does not generally provide individual crypto investors with a capital gains tax discount simply because an asset was held for more than 1 year. Allowable crypto capital losses can generally offset chargeable gains. If losses exceed your gains, the remaining amount may normally be carried forward for use against future gains. Crypto received through employment, services, or business activity may be taxable as income. The euro value when received is important for both the income calculation and a possible later disposal. Being paid in crypto does not remove payroll obligations. Employment payments and benefits are generally valued in euros when paid and processed under the normal payroll rules. Revenue has not created a separate rule covering every staking arrangement. Rewards may be income when earned or received, while selling or swapping the reward later may create a separate capital gain or loss. Mining treatment depends on the facts. A commercial mining operation may produce taxable trading income, while other circumstances may require different treatment. Ireland does not publish a separate rule for every type of airdrop or fork. The treatment can depend on why the tokens were received and whether the receipt was connected with an activity, service, or trade. DeFi and NFT transactions must be analyzed based on what actually happened. Depositing tokens, receiving another token, earning rewards, and later withdrawing may represent separate transactions.
Giving crypto can trigger CGT for the person making the gift. The person receiving crypto may also need to consider capital acquisitions tax, depending on the value and their relationship with the giver. Ireland's small gift exemption may cover gifts worth up to €3,000 received from each giver during a calendar year. This concerns CAT for the recipient and does not automatically remove the giver's CGT position. Lost keys, theft, exchange failures, and scams can have complicated tax treatment. Keep detailed evidence and obtain professional advice before claiming a loss. Ireland implemented the Crypto Asset Reporting Framework and DAC-8 from January 1, 2026. In-scope crypto service providers must collect information that may later be reported and exchanged between tax authorities. Your records should allow every transaction and calculation to be reconstructed. Keep exchange exports, wallet history, euro valuations, fees, addresses, and blockchain transaction identifiers. Irish revenue requires crypto-related tax records to be retained under the normal record-keeping rules, generally for 6 years. This also applies to records stored in wallets, vaults, phones, and computers. A major Irish tax mistake is waiting for the return deadline before paying CGT. Payment may be due months earlier, and a return may still be required when losses or exemptions reduce the tax to zero. The form used depends on whether you are a PAYE taxpayer, self-employed, otherwise within self-assessment, or operating through a company. Check your revenue registration before filing. Start by collecting all exchange and wallet records, match transfers, separate income from disposals, calculate euro values, review gains and losses, and prepare the figures required for your return. Crypto Tax Bridge helps organize your crypto transaction history, review taxable activity, calculate gains and losses, and prepare PDF and CSV reports for filing or sharing with your accountant. Before completing your return, check that all platforms and wallets are included, euro valuations are supported, transfers are matched, income is classified, and CGT payments were made by the correct deadlines. Prepare your Ireland crypto tax report with Crypto Tax Bridge, import your transactions, review your activity, calculate your gains and losses, and export your reports. The link is in the description.